Hey everyone, today Rivian announced their Q2 2023 earnings. They also just finished the earnings call. We have a lot to get into, but before we do, if you could smash the like button, and if you haven't subscribed to the channel, please subscribe. Let's get into it. Alright, starting off, they go with key highlights for the quarter. 50% increase in production versus Q1. So this is a 50% increase quarter over quarter. This isn't year over year. So a huge increase in production, which is extremely important because they need to increase production and scale that business to be able to fund everything else and grow as a company. It all basically starts at what is the capacity of their factory and can they produce at that capacity. So they are increasing production. They also announced how the dual motor was added to the R1 lineup. We already knew they brought in their own Enduro dual motor from Rivian for the EDVs, their commercial vans. Well, now it is implemented on the R1 lineup for their R1 SUV and the R1 truck. 2023 adjusted EBITDA guidance has been improved to a loss of $4.2 billion for the year. This is an improvement over the original loss that they had, which I believe they were expecting it to be at, I think, $4.3 billion, but we'll get into that in a minute. But it is an improvement, so improved guidance. They now also talk about a $35,000 gross profit per vehicle delivered improvement. So they've had huge losses on every car they delivered because they weren't at scale. But just quarter over quarter, so versus Q1, we're not talking about year over year, the improvements they've made with ramping the production, reducing material cost, and increased revenue per vehicle has led to an additional $35,000 going per vehicle delivered into that gross profit number. It's still negative, but it is an increase of $35,000 compared to a quarter ago. So good improvement there to eventually getting to that break-even gross profit, and then eventually their ultimate goal of 25% positive gross profit margins on the vehicles. They then increased total production guidance for 2023 to 52,000 vehicles. This is up from 50,000, so a 2,000 increase, which is a 4% increase. It's a good step in the right direction. I think they're being conservative. I think they're going to outdo the 52,000. But RJ is the kind of guy who likes to beat the numbers that he guides to. So I think that is why he only increased it by 4%. Lastly, 2023 CapEx guidance has been reduced to $1.7 billion. I believe this is down from $2 billion, so a $300 million savings on CapEx for the year. So let's get into some of the other things they talk about, including the customer experience. So as more Rivian vehicles are on the road, they're equally focused on scaling the service infrastructure to enhance customer experience. They currently have over 280 mobile service vehicles on the road, which are handling over 50% of their vehicle repairs. And they also say that their Rivian service vehicles allow them to continue to lead with a mobile-first strategy and deliver a sustainable, convenient service experience for their customers. In addition, they have 43 physical service centers opened with an additional 17 scheduled to open by the end of the year. So they are increasing their service centers, and they obviously have a much greater focus on mobile service and coming to you. This is something Tesla has been doing for a little while now. And I'm glad that Rivian clearly sees the advantages, not only for Rivian, but mainly for the customer. When you have a problem with your car, having Rivian come to you and perform the maintenance, if it's able to be done on site at your home or at your work, is so much better than making you go and wait at their location or have to take an Uber home or get a loaner vehicle. It's better when they can work at your house and get it fixed and work on your time rather than you working on their time. And for those unaware, Rivian does use their commercial EDV vehicles for their own mobile service vans. So when you have a Rivian and you need service and they come to you, they're coming to you in a Rivian. So they're using their product and it's awesome, and I'm sure saving them money versus buying vehicles from another manufacturer to do that. Next, quarterly production. Probably the most important number for them right now in this stage of the business. It is 13,992 vehicles for this quarter. What's really important is there is a just nice increase going up from Q4 of 2021, quarter over quarter over quarter. We saw a slight decline Q4 to Q1, but that is very normal. Basically, Q4 is the busiest quarter of the year for the auto business, and Q1 is the lightest quarter of the year for the auto business, but barely a decline there for them. And then right away, obviously, jumping up into a huge increase in production up to that almost 14,000 vehicle production rate for the quarter. So I am happy with these production numbers, which we got prior to the earnings. Now looking at deliveries, which we also received prior to earnings when they released these at the end of the quarter was 12,640 vehicles delivered. So the big important thing here to note is it's not just them increasing capacity for production. They have people, they have a huge wait list that want to buy these cars. They have the demand, so they are delivering on these vehicles produced. There's always going to be slightly more produced vehicles than delivered vehicles, simply because cars don't just go immediately off the factory line right to the customer. They have to get brought to different locations, shipped, and then they have to wait for the customer to come, sign the papers, take them, etc. But we're seeing nice, huge increase in deliveries as they scale production, and I believe we're going to continue to see that going forward. Next, we're going to talk a little bit about their software architecture. So they talk about how they developed this in-house complete end-to-end solution, providing significant flexibility as they continuously optimize the vehicle's performance and the customer experience. They say that the vertical integration of their electronics and software platforms enable them to seamlessly improve the customer experience through new features and enhancements. They can collect diagnostic data to support targeted over-the-air updates, as well as key feature improvements. Diagnostic data collection has allowed them to monitor the vehicle health parameters and verify that vehicle performance meets their expectations while also contributing to reduced service costs. So they say as their fleet grows, they're going to expect to see significant cost savings and customer value through predictive service and repair operations. Their vehicle software architecture also supports the manufacturing operations, where it provides inline diagnostics for earlier and improved quality control. They then go on to say that in 2024, they intend to further build upon their vertical integration approach and differentiated software capabilities with the introduction of their next generation of network architecture that will be included in the R1 platform, and it's going to serve as the foundation of the R2 platform. They say that their updated network architecture is expected to reduce 60% of the electronic control units, the ECUs, and reduce the wire harness length by 25%. They expect these adjustments will result in lower cost, less vehicle mass, improved manufacturing efficiencies, and reduced electrical architecture complexity. They believe this next generation of network architecture will significantly contribute to steps they're taking to aggressively reduce material cost per vehicle. Now, all of that said, that's something I think that really goes under the radar. Other than Tesla, I really don't know another auto company that is really taking this much in-house, this much of the architecture, the software, the hardware, and the entire architecture behind it all. Rivian is doing exactly what an investor, in my opinion, should want them to be doing. They're going to control their own destiny with things like this. And we even got a greater insight into some of what this next generation architecture might include during the earnings call. An analyst on the earnings call mentioned how Rivian is currently using Mobileye for their cameras and sensors, and how they're going to be putting in their own system and their own sensors to basically simultaneously to move to their own sensors, and was asking kind of like when they would get rid of Mobileye and just move to their own sensors. And this has to do with autonomy, the driver plus features, etc. And the fact is, they're basically decided they don't want to rely on anyone. They're going to get rid of Mobileye sensors and software and whatnot, and they're going to move into their own sensors, their own software, controlling everything. And what I think that's going to see is huge improvements on all the autonomy front. I mean, we got the recent news of the ex-CEO of Waymo joining their board. We know they're taking autonomy seriously. They don't want to say anything too deep in there because they clearly are not there yet, but they clearly have the ambitions for it, and they're not, messing around. They know they're going to collect mass amounts of data with a big fleet on the road, and they're going to take advantage, and they want to control that data. They want to control the software. They want to control the sensors so that they can get the cost efficiencies with those. It's really good news in my opinion. Next up, let's talk about expanding the charging features and scope for their business. They talked about recently announcing the acquisition of Eternio. It's the company that develops ABRP, a better route planner. Now, I've discussed in past videos about that acquisition, but they say in this earnings report, they mention how it's going to provide the data to help them with site selection of their Rivian Adventure fast charging network. This is something I've mentioned in a past video, where they're going to be able to use the data from that company of all these vehicles trying to plan their trips and where to charge, and be able to help find inefficiencies where there's missing chargers that might be helping with the route planning if there was a charger there, and give Rivian a reason to have a better understanding of where a charger might actually perform better or where it's underutilized and needed, different things like that. Just it's good that they're fully aware of the opportunities of this acquisition, and I'm glad that they are taking advantage of it. And it's also obvious the additional advantages they'll have with the navigation improvements and the trip planning improvements for Rivian customers as well. Then they talk a little bit about the RAN, the Rivian Adventure Network that they're building out, their version of the supercharger network. They talk about many chargers, being built out, how many they have. So they say through their collaboration with Tesla, Rivian drivers are going to have access to more than 12,000 superchargers as early as the spring of 2024. We already knew about their NACS deal with Tesla, that they're going to be adding the North American charging standard onto their vehicles and also be using North American charging standards as plugs on the Rivian Adventure network as well. Some additional insight on that network is they continue to grow it. They're saying that they currently have 44 Rivian Adventure network sites and 273 chargers. They want to grow that network. They want to add the NACS compatibility to the Rivian Adventure network, so past vehicles that have CCS still will be able to use NACS through an adapter. And a large benefit that I think some people maybe haven't realized is not just that Rivian customers will be able to use the Tesla supercharger network, which is great for Rivian customers and Rivian, but that Tesla customers, where there's a huge fleet of Teslas on the road, will be able to charge at Rivian Adventure networks, which on this earnings call, they've pointed out will actually lead to the Adventure network becoming profitable sooner than it normally would be, because they'll have the Tesla customers being able to pull up and have a Tesla charger, a North American charging standard charger, plug right into their vehicle and work seamlessly. Then they get a little bit into expanding their impact with Amazon. We know that these EDV vehicles that they have been producing and delivering to Amazon made their first trip into Europe. They talk about how they want to still, bring 100,000 electric delivery vehicles on the road with Amazon. And as of early July, there were EDVs in operation across over 800 cities in the United States. So clearly, they are continuing this nice expansion with Amazon, getting these vehicles out on the road, tested, and building upon their commercial business. They talk on the earnings call about how, although there's no end right now for the exclusivity with Amazon, they are still in talks with Amazon, and it will be mutually beneficial since Amazon is a large shareholder of Rivian. I think they are going to get there. My guess is by end of year, we will see that exclusivity end, and we will see them start to deliver these vehicles to other companies in 2024 and beyond. Now let's get into some of these raw numbers. We knew for revenue, they did $1.12 billion in the quarter. This was driven by deliveries of the 12,640 vehicles. The total revenues included $34 million of the sale of regulatory credits. So as they are selling more vehicles, they can now get into the business of selling regulatory credits to other automakers that are not selling enough EVs yet and have to buy these credits to be in compliance with the gas cars they're currently selling. So as they increase production, they'll probably have more and more revenue from regulatory credits like we've seen with Tesla in the past. But as other companies obviously make and sell more EVs themselves, they won't need to buy as many. So we'll see how it goes. They did mention on the earnings call the sale of regulatory credits varying quarter to quarter. Next, the net loss. So their net loss for the second quarter was $1.195 billion. This was compared to a net loss of $1.712 billion for the same period last year. So obviously year over year, we saw a much smaller net loss, basically $500 million savings, a little more than that. When it comes to the liquidity, they ended the second quarter with $10.2 billion in cash equivalents, and short-term investments, including the capacity under their asset-based revolving credit facility. They ended the second quarter with $11.3 billion in total liquidity. And as of the earnings call, we also were told that it's enough liquidity and cash for them to get through 2025 without raising any money. Now, they could raise money, obviously, if they want to increase their cash balance and increase their balance sheet to be even more protective beyond that, but they obviously have enough cash to make it through 2025, even if they didn't raise any money. So that's a great thing to have a nice, strong balance sheet. When it comes to their 2023 outlook, they remain focused on ramping production, implementing core technologies designed to reduce cost and improve the customer offering. And based on the progress of their production ramp, including the ramp of their in-house motor, the Enduro motor, Along with their latest understanding of the supply chain, they're increasing their production guidance, like we said, to 52,000. They also seen strong progress in their cost reduction efforts, and that's why they're improving their adjusted EBITDA guidance to a loss of 4.2 billion. And finally, they've reduced the expected capital expenditures, like we said, down to 1.7 billion rather than the 2 billion. Now, looking at this chart, the most important part is that gross margin. They need to get to positive gross margin so that they can eventually be a profitable business. If they're selling cars at a loss, it's not really going to do anything good. They'll go out of business eventually. So they need to eventually get that gross margin positive. They have basically said that they want to get to eventually, it's going to be 25% gross margin. I think they definitely can do it. Tesla's shown that it can be done. They don't have to sell to dealers. They can sell direct. There's a lot of benefits between the vertical integration, etc. So the question is, how have they progressed on that goal of getting to positive gross margins? We know that their gross margins for this quarter were negative 37%. The estimate going into the earnings report was negative 58%. So although negative 37% margins is bad, it's a huge improvement, not only compared to a quarter ago or a year ago, but compared to what the market thought. The market thought, the estimates from the general estimates from banks that cover the stock was negative 58% margins, and they came in at negative 37%. So they're obviously doing really well with savings and scaling that production. When we look at it just a quarter ago, it was negative 81% gross margins. If we look at it a year ago, it was negative 193% gross margins. So we've seen a nice increase in the gross margin trajectory, going from negative 193 to negative 171 to negative 151 to negative 81, and now this huge jump to negative 37. And why such a big jump? Because they had a big increase in production, and as they scale out that production, we're going to see that gross margin hit break even and eventually positive, and ultimately around that 25% gross margin point that they have guided to long term. Next up, we want to look at that balance sheet a little deeper. So for their assets, their cash and cash equivalents, they were at 9.26 billion. They also had short-term investments of around $1 billion, 942 million. They then have some account receivables, a little bit of inventory, around 2.1 billion, total assets of like 7.2 billion. The most important thing I see when I look at this balance sheet is that their cash on hand is enough to cover total liabilities, not just current liabilities. Total liabilities for the entire company sit at $5.513 billion, and they can easily cover that with their cash and still have significant cash left over. Most important for them is to get to a point where they're having cash flow coming in, positive gross margins, and that's going to be scaling and getting there, but they have the cash right now to take them where they need to go. They are not sitting with a ton of debt and not enough cash or anything like that, over-levered. They have a nice balance sheet when it comes to just cash and debt and looking at that. So where's the stock? Well, the stock first went up after hours, then it went down. On the screenshot, you could see it was down 2.5% or so after hours at the time of that screenshot. Looking at it right now while I'm recording the audio, it's up about 0.2, 0.3%. So it's basically flat, let's just call it. It went up a few percent, went down a few percent, now it's kind of flat. Where it goes tomorrow, I have no idea. We'll see. What matters to me more is how the business is moving along, what the management is saying. Do I still believe in their mission, in the company, in the forward trajectory of this company, the future earnings of this company? And to me, the answer to that is a resounding yes. They beat estimates. Estimates for Rivian going into this earnings report was EPS of $1.43. They were expected to lose $1.43 per share. They came in at a loss of $1.27 a share, 16 cents better than analysts estimated. So they beat on the EPS. When it came for revenue, that's another beat they had. It's the first time they had over $1 billion in revenue, and the revenue was 1.12 billion. The estimate was 1 billion, so they did 120 million more. Percentage-wise, really nice beat. Now, I'm still extremely bullish on the stock. They talk about things, we're used to valuing Tesla and Rivian as car companies when we look at analysts, not me personally, but analysts. They look at it, it's a car company. And they try to value it a lot of times as car companies. More and more as Tesla has proven what it can do, I think the analysts have started to get a better understanding and are giving obviously better value to Rivian now because of that. That said, there's so much that's not being valued in. Something as simple as the insurance offering he mentioned on the earnings call has such a high attach rate. It's positive for them. The ultimate success of their charging network, the Rivian Adventure network, what software can do for them, what autonomy can do for them. There's just a lot that goes into it. I am super bullish. I bought more stock today while listening to the earnings call. I just was very happy with everything I heard. If you're invested in Rivian, if you have questions about Rivian, if you are curious about anything on the earnings report or this video, feel free to comment below. If you haven't liked this video and you made it to the end, please smash the like button. It really helps the channel. I really appreciate it. And if you're not subscribed but you enjoyed this video, definitely subscribe to the channel. Now, lastly, if there's a stock you want me to do a deep dive in or go over an earnings report on or just give you my opinions on, comment the stock below. I'm happy to take a look.